Intercompany inventory transfers. We're going to continue with our downstream transactions, and in this lecture we're going to look at case 2, when all of the inventory purchased by the subsidiary is sold to third parties in the next year. So we'll have some deferred gross profit that we have to address. Just as a reminder, these recordings include only the intercompany inventory transfer information. All of the consolidation accounting and equity method accounting for all the other transactions are included in the lecture notes. Alright, so case 2, all the inventory sold in the second year. We still have to address the equity side of this, and we'll continue with our special allocation item, the sale of the inventory. So real briefly, here is the inventory transactions that took place from the time the parent bought the goods to the time they were sold. For consistency, we'll use the same numbers as we saw in case 1. The only difference is the subsidiary sells the goods in March of X2 instead of November of X1. So we'll debit inventory and credit cash on the purchase. And then you can see here, this is the entry the parent will record when they sell the goods to the subsidiary. And then when the subsidiary buys the goods. And these entries are the same for case 1 and case 2. Here's where there are some differences. The subsidiary did not sell any of the goods in X1, so that means they're still on hand. So we must ask, is there any deferred gross profit? Is gross profit stated correctly? Is it overstated or is it understated? You need to go ahead and set up an inventory transfer worksheet, and this is the information that we know thus far. We ask, has anything been sold to third parties? The answer is no. So what that means is all of the items remain in inventory. And as we said earlier, the bottom right hand cell will be the deferred gross profit. And if we look at the gross profit on the third line, we ask, of the $15,000 in gross profit from the transaction, has any been sold to third parties? No. So that means all of it is deferred. So we have to account for that. And we must account for that as soon as we know about it, and we'll address that in the equity method of accounting. The next thing we have to address are the intercompany transfers, and we'll use this for our EJEs and our consolidation accounting. We know that revenues are $42,000, and we know that the cost of goods sold values will be the values in the ellipse, which is 0 plus $27,000. And it's kind of clear here when you look at it to ask ourselves, has anything been sold to third parties? No. So that means the parent cannot recognize any of the revenues nor any of the expenses related to that sale. And we see another thing as well. The subsidiary has inventory on their records for $42,000. Is that the correct value of the inventory? Is that the value paid for from third parties? The answer is no. That value is $27,000. So what we can see is that the gross profit amount, we can't recognize it, so we have to do something with it. And that something with it is we're going to put it in inventory. So we're going to set it in inventory temporarily, and that's going to do two things. It's going to give the deferred gross profit a place to sit for a while, and secondly, it's going to state inventory at its correct value. Not at the overstated value of 42, but at the stated value of 27,000. So what do we do with the equity method? Well, we know there's some deferred gross profit. So similar to what we've done in prior chapters, any transactions between the parent and the subsidiary during the year, we will run it through the income sub-account. So in this case, the parent has $15,000 of gross profit on their records. Their gross profit, their net income and gross profit is overstated. So we have to address that. So we're going to debit the income from sub-account. And we're going to temporarily put it into the investment sub-account on the credit side. Now, you need to ask yourself, in the past, if we've done anything to the income sub-account and there has been an NCI, we've allocated it out. And whatever the ratio is, in this case 80-20. Well, with this particular transaction, we ask, is it It's going downstream. So does the NCI have any control over that downstream transaction? No. So any of the profits that the parent has, it's all theirs. So in essence, what we're doing here is saying 15,000 times 100%. When we look at our income from subsidiary, we can see that the $15,000 of deferred gross profit we're going to subtract out of the $88,000 to get $73,000, and we're not going to allocate this out to the NCI. Just as a reminder to you, all equity method entries will be posted to the investment subsidiary account. So if we make an equity method entry during the year, it's going to end up here. All right, let's look at the consolidation at the end of X1. We're going to pick up with EJE number 4. Items 1, 2, and 3 relate to the consolidation accounting that we've covered already. Now, let's ask ourselves, what did we do during the year? Because you know that we're going to eliminate all equity method entries that we made. So again, we will always eliminate any equity method entry that we make in the consolidation process. This is what we made just a second ago. In actual practice, it's kind of odd here, but in actual practice we're making this entry every quarter, and then at the end of the year we're consolidating. So for us it's a little odd because we're making this entry, then we're immediately reversing it out. So in actual practice there's a time period there. So this is what we did. We debited income, credit the investment. Well, we have to reverse that out, because if we don't, we're going to end up with something like this. Now remember, the $73,000 consisted of the subs net income of $88 plus the debit of $15,000, $73,000. So we have to get rid of that, or the income sub account won't be zero. So this is the entry we're going to make for consolidation purposes. We're going to reverse that equity method entry out. I'm going to debit the investment sub, credit income from sub. Now that leaves us with a new entry. We did this kind of in case 1, but it'll be more in detail this time. So we've taken care of the deferred gross profit. Let's properly state the revenues and expenses. We will eliminate the revenue, and we'll add up the items in the ellipse for the cost of goods sold amount. And as you can see here, it's kind of clear that the subsidiary did not sell any goods. So for consolidation purposes, the parent can't recognize any of that revenue, cost of goods sold, or gross profit. So here's what we're going to do. We're going to debit revenue, $42,000, credit cost of goods sold, which is represented by 0 plus $27,000. And the inventory, we could say it's a plug number. It's going to be the difference between the two. But really, that's the deferred gross profit amount. And that's the amount that's also going to make inventory be stated properly at $27,000. Now, here is the partial 3-part worksheet with everything posted. And you can see that the revenues are 0, cost of goods sold is 0. And you can also see that inventory is stated at its correct value. Notice with our consolidated income statement that we start with separate operating income, and we must subtract out any deferred gross profit that we have to get what we refer to as an adjusted separate operating income. Alright, we've done all the year 1 activity. We have to address the inventory being sold in a next year, and our next year is going to be X2. So we've deferred the profit in year 1. We're now going to recognize the profit when we actually sell it. So let's see what we do there. We're still going to do our equity method of accounting, and we are in an equity section now, so last time we had deferred gross profit. We're now going to have realized gross profit. So here's the inventory transaction. On March, we sold the goods for $66,000, and here's the journal entry. Now, is the gross profit over or understated? Well, this is what our income statement looks like at this point. Okay. So, is there any deferred gross profit? Yes. Not in this year, but last year the parent deferred $15,000, so we must now incorporate that in to our income. So here's what we see. That was deferred last year, so we must incorporate it in this year. So what we're going to do is the following. We're going to put that deferred gross profit in inventory, in the cost of goods sold account. We put it in inventory originally to adjust inventory and to temporarily put the deferred gross profit. Now we're going to put it back into cost of goods sold. And the way this reads is this. Remember, gross profit is revenues minus cost of goods sold. Well, in this case, revenue minus a minus makes that a positive number, and we get a positive gross profit of $15,000. We know the parent's gross profit is understated, so how are we going to bring that into the income? Well, last year we took it out of income sub. This year we're going to add it back in. So we're going to make the following entry under the equity method. And again, the same concept holds. This gross profit originated with the parent, so we will not allocate it out to the NCI. Just like we subtracted it out last year, we'll add it in this year. And again, we will post all equity method entries to the investment sub-account. And if you're kind of keeping tabs of this, in X1, that was a credit. In X2, it was a debit. So over a 2-year period, it nets out to 0. Let's look at the consolidation accounting at the end of X2. Let's pick up with our equity method entry, our deferred gross profit. What did we do just a second ago? This is the entry we made. If we don't do something with it, we're going to end up with $15,000 in the consolidated income sub-account. So we're going to reverse it out with this entry here. Debit income from sub, credit the investment. Now let's talk about EJ number 5, properly reflecting revenues and expenses. We've said this before, but we must properly reflect revenues and expenses. And what we've seen here is that we've got $15,000 we've got to incorporate in to our consolidated income. Well, let's begin by doing this and ask ourselves, what did we do last year with this deferred gross profit? This is the entry we made in X1. Well, where do revenues and expenses go after they're closed out? You should know, retained earnings. That is correct. But in our case, since we're dealing with a transaction between the parent and the sub, we're going to run these revenue and expense accounts not in retained earnings, but in the investment subsidiary account. This investment subsidiary account is like a retained earnings account for the investment. So we're going to change our entry a little bit, and any revenue and expense account that we have in the second year, we will strike through it and put investment sub. We will do the same thing for cost of goods sold. Now, obviously, you can see here that we have 2 entries to investment sum, one a debit, one a credit. If you would like to combine them, feel free to do so. I would suggest for now, until you're comfortable with everything, that we list them out individually. So we've taken our X1 entry, we've modified it a little bit, and we're left with one thing that's there, and that's the inventory. Well, the inventory, the deferred gross profit is gone, so we can't leave it in the inventory account. We saw a few slides earlier, we put it in cost of goods sold. So what we're going to do is any deferred gross profit, when we recognize it, we're going to credit cost of goods sold. So we end up with a clean entry that looks something like this. And you can see on our partial three-part worksheet that we take any deferred gross profit, put it in cost of goods sold, and it's going to reduce cost of goods sold, which will in turn increase net income. And then lastly, with our consolidated net income, in year 1 we subtracted the deferred gross profit. In year 2 we're going to add it to our separate operating income. This concludes a discussion on case 2, inventory sold by the subsidiary in the second year.